A stock has been surging for days. Do you dare to chase it? Or it just crashed hard? Is this a bargain, or a falling knife? Every investor faces these questions, and gut feeling is usually the worst way to answer them. Today we are covering the RSI, the Relative Strength Index. It is one of the most widely used tools in technical analysis, built precisely to answer this question: is the market too hot, or too cold? Over the next 8 minutes, you will learn how it works, how to read it correctly, 2 practical ways professionals actually use it, and 1 dangerous trap that costs beginners real money. Let's get started. The RSI, or Relative Strength Index, was introduced by the legendary technical analyst Welles Wilder back in 1978, and it has stood the test of time for nearly 5 decades. The idea behind it is surprisingly simple. Over a recent window of time, it measures one thing: who has been stronger, the buyers or the sellers. Think of it as a thermometer for the market. The scale runs from 0 to 100. The closer it gets to 100, the stronger the buying pressure, and the hotter the market. The closer it gets to 0, the more the sellers are in control, and the colder things are. One number, one glance, and you instantly know the market's temperature. That simplicity is exactly why traders around the world still rely on it every single day. So how is it calculated? Let's walk through it using the standard 14-day setting. Step 1. Take the last 14 trading days, and average the gains from all the up days. Step 2. Average the losses from all the down days. Step 3. Divide the average gain by the average loss. This gives you RS, the relative strength. Step 4. Plug it into the formula. RSI equals 100, minus 100 divided by 1 plus RS. Sounds a bit convoluted, but the intuition is dead simple. More up days and bigger gains push the RSI higher. More down days and deeper losses drag it lower. And here is the good news: you never need to calculate this by hand. Every charting platform has it built in. What matters is understanding what the number actually represents, the balance of power between bulls and bears. Now, how do you read it? There are 3 classic levels to remember. First, 70. When RSI climbs above 70, we call it overbought. The market has rallied hard in a short time, and sentiment is running hot. Second, 30. When RSI drops below 30, that is oversold. Prices have fallen fast, and fear is dominating. Third, the 50 line in the middle. That is the battle line between bulls and bears. RSI holding above 50 generally means buyers have the upper hand. But here is the single most important thing in this entire video: overbought does not mean the price will drop tomorrow. Oversold does not mean it will bounce right away. These are temperature readings, not trading signals by themselves. Keep that in mind, because the trap we cover later is built entirely on this misunderstanding. Time for a real example, with real market data. What you are seeing is an actual price chart, with the RSI plotted below it. Watch what happens when the RSI dips below 30 into the oversold zone. In the days that follow, the price stages a clear rebound. Now look at the other side. When the RSI pushes above 70 into overbought territory, the price soon pulls back. This back and forth pattern is where the classic RSI signals shine, in a sideways, range-bound market with no strong trend. When prices are oscillating within a range, RSI extremes can help you spot relative highs and lows with impressive consistency. But remember the key condition here: this works best in choppy, range-bound conditions. That distinction will matter a lot in a couple of minutes. The second technique is what many veteran traders consider the most valuable RSI signal of all: divergence. Look closely at this real case. The price makes a new high, clearly higher than the previous peak. But look at the RSI at those exact same moments. It failed to make a new high. In fact, it printed a lower high. Price and momentum are now telling 2 different stories, and that disagreement is called a bearish divergence. Here is what it means: the price is still rising, but the force behind the rally is quietly fading. Fewer buyers are pushing with less conviction. And as you can see in this example, shortly after the divergence appeared, the stock rolled over into a meaningful correction. Now, divergence does not guarantee an immediate reversal. But it is one of the best early warning signals in technical analysis, and when you see it after a long rally, it is time to pay serious attention. And now, the most important part of this entire video, the trap. It is called RSI failure or sticky overbought, and here is a real example. Notice how the RSI crossed above 70 early in this move. If you shorted the stock right there just because it was quote-unquote overbought, what happened next? The price did not fall at all. It kept climbing, week after week, while the RSI stayed glued to the overbought zone the entire time. This is the phenomenon. In a powerful trending market, RSI can remain at extreme levels for weeks, and the classic overbought and oversold signals stop working completely. Shorting a strong uptrend just because RSI looks high is the single biggest source of losses for beginners using this indicator. So the rule is clear: first determine whether the market is ranging or trending. RSI extremes are reliable in ranges. In strong trends, respect the trend. Let's wrap up with the 3 key takeaways. Number 1. RSI measures the balance between buying and selling pressure. Above 70 the market is hot, below 30 it is cold. Number 2. Use overbought and oversold signals in range-bound markets, and watch for divergence as an early warning in trending markets. Number 3, and most important of all, in a strong trend, RSI gets sticky and extreme readings lose their meaning. Never make a trading decision based on a single indicator alone. This video is for educational purposes only and is not investment advice. All investments carry risk, so always do your own research. Thanks for watching, and see you in the next one.